Have you ever wondered how credit spreads work in trading? It's a question many traders grapple with, and today we're delving into it. At its core, a credit spread is a type of option strategy that uses the simultaneous purchase and sale of two options of the same class but with different strike prices. Now, why is this important? Because it's a strategy that allows traders to limit their risk while still having the potential to turn a profit. It's like having a safety net while you're walking a financial tightrope. Here's an easy way to visualize it. Imagine you're at a market and you buy an apple for $1, but at the same time you sell an apple for $1.50. You've just made a 50-cent profit, right? That's the basic idea behind credit spreads. Understanding credit spreads can open up new strategies for traders to profit in various market conditions. So, let's dive deeper into this fascinating world of trading. Now, let's delve into each leg of a credit spread. In the world of options trading, a credit spread has two legs. Picture it as a journey with two steps. The first step is selling an option, and the second step is buying another option. Both options are for the same underlying asset and have the same expiration date, but they have different strike prices. Let's break this down further. The first leg of the journey is selling an option. This is the option that is more expensive. Why? Because it is closer to the money, meaning the strike price is closer to the current price of the underlying asset. This option is sold to generate a premium or credit, hence the name credit spread. The second leg of our journey is buying an option. This option is less expensive because its strike price is further away from the current price of the underlying asset. This option is purchased as a form of insurance to limit potential losses if the market moves against the trader's expectations. So why does a trader sell an expensive option and buy a cheaper one? Here's the catch. The premium received from the sold option is used to pay for the purchased option. This results in a net credit for the trader. The difference in premiums between the sold and bought options is the trader's maximum potential profit. This strategy is like a high-wire act. It requires balance and precision. And just like a high-wire act, the thrill comes from the risk involved. The risk lies in the difference between the strike prices of the two options. This is the trader's maximum potential loss if the market moves against their expectations. In essence, traders use the premium from the sold option to pay for the bought option, pocketing the remaining credit. The credit spread strategy is a game of balance, a dance with risk and reward. And when executed correctly, it can lead to significant profit, all while limiting potential loss. Have you ever considered the implications of your spread's width on your collateral? Let's dive deeper into this crucial subject. Your spread can be likened to an investment scale, with its width denoting potential. However, it's important to remember that with a wider spread, the risk of loss mounts. Wider spreads offer more premium and a higher chance of success in the trade. But wider spreads also require more collateral and a higher max loss on the trade. In simple terms, it's all about finding the perfect equilibrium between potential profit and risk. Keep a wider spread may lead to larger profits, but it also requires more collateral and introduces a higher risk. Wondering when and what delta to sell at? Let's explore. Timing, as they say, is everything, especially when it comes to selling options. So what's the optimal time frame to consider? Well, we suggest selling options with an expiration of 6 to 8 weeks. This timing has its benefits. It's long enough for the market to make its move and short enough to limit exposure to unforeseen market volatility. Now let's talk about delta. For those new to the game, delta represents the rate of change between an option's price and a $1 change in the underlying asset's price. In other words, it measures the option's sensitivity to price changes in the underlying asset. We recommend selling at a delta of -0.2. Why -0.2, you ask? It's because this delta value provides a good balance between risk and reward. It's not too risky, but it still offers a chance for a decent return. So what does all this mean in terms of potential earnings? Well, combining this timing and delta strategy offers an 85% chance of achieving a 50% return sometime during the 6 to 8 weeks. That's a pretty decent probability, wouldn't you agree? But as with all things in trading, it's not a guaranteed win. The market can be unpredictable, and there's always the chance that things won't go as planned. In conclusion, while selling options with an expiration of 6 to 8 weeks and a delta of -0.2 offers a good chance of achieving substantial returns, it's not without its risks. It's crucial to carefully consider these risks and make sure you're comfortable with them before jumping in. After all, it's your hard-earned money on the line. Remember, while this strategy offers an 85% chance of a 50% return, it's essential to consider the risk involved. We've covered a lot today, haven't we? We've delved into the intricate world of credit spreads, breaking down each leg to understand how they work together. We've explored how the width of the spread directly impacts the collateral and, consequently, your risk and potential return. We've also shared some insider tips on the optimal timing for selling, recommending a time frame of 6 to 8 weeks before expiration. And we've discussed the concept of selling at a -0.2 delta, a strategy that offers an 85% chance of achieving a 50% return sometime during the 6 to 8 weeks. Remember, while credit spreads can be a powerful tool in your trading arsenal, they come with their own set of risks. As with any strategy, it's crucial to understand these risks and to use credit spreads wisely and judiciously. Make sure to hit that like button and subscribe for weekly videos on the stock market and trading strategies. Until next time, happy trading.